A global synchronized tightening cycle might be upon us. We've got to figure that out, what it means for this equity market. For last week, the biggest weekly gain on the S&P of the year so far. We add to it just a little bit, up 6 points on the S&P, up a little more than 1/10 of 1%. On the NASDAQ, up a little more than 1/10 of 1% going into your opening bow. That is your opening bow. Switch at the board and get to the bond market. Two-year yields through 130 over the last couple of days, through 190 on 10s. That sticks. 192, 191, 95 on 10s, up a single basis point. In Italy, at the front end on a two-year, 50 basis points higher in 6 sessions. We've got to talk about that through the morning right here on Bloomberg TV. I know Guy Johnson laser focused on it. Euro dollar 114.26 with negative 0.2 of 1% on that currency pair. Just bear in mind this, even the most hawkish policymaker on the Governing Council right now is only thinking about a 25 basis point hike in Q4 and another one in spring. Things can change, but that's where the likes of Klaus Knot is right now. Crude at 91.50, negative 0.9 of 1%. We pull back on WTI and on Brent as well. We caught up with RBC's Lori Calvasina a little bit earlier this morning, weighing in on the results so far this earnings season.
It seems to me like it's going to be a messy quarter. Now, we haven't really seen companies, sit here and say things are a disaster, right? Like if you look at the consumer in particular, people are being vigilant. They're watching the low end. But I would say that the confidence level does seem to me a little bit shakier than what we've seen, sort of the past few quarters.
Back with us, Victoria Green, Marco Purvis, Colin Martin. Victoria, where's the confidence come from going into an earnings print where a mega cap can move 20% either way off the back of it? Where'd you get the confidence from that?
I think you have to have confidence in your underlying companies. Last year, a rising tide lifted all boats, right? You could almost like throw a dart at the dartboard and companies were making money. This year, it's going to matter who your management team is, what the cash flows is, how they've managed labor and inflationary costs. And so I think this is a good year to be active, a little less into passive indexes, because I think it's going to really matter what you own. If you look at the dichotomy of just automakers, and I know it's not apples to apples, but what Tesla did versus what Ford did, or what, Snap did versus and Twitter did versus what Facebook did, instead of being able to say all auto companies or all social media companies, you're having to actually look around and say, okay, who is the best run company, or who has the best growth prospects, who's managing during an inflationary period better, because the chip shortage didn't hit everybody equally, the labor inflation costs didn't hit everybody equally, and so you have better companies managing this crisis and managing through a different cycle. And so I think it really, really matters, and I'm not surprised. It's kind of nice to see it where the fangs of the world just outperform everybody. It is going to matter which ones you own. And obviously Google and Amazon and Apple, they were absolutely stellar. I mean, it's hard to bet against them. But at the same point, you had your reminders with Netflix and Facebook. You got to watch those valuations, and you got to feel comfortable in the company's growth prospects going forward. I think it's funny because it no longer matters what did you do for me last year. All we care about is what are you going to do for me now.
And next year and the year after. Michael Purvis, to Victoria's point, it's not just about sectors versus sectors within sectors. Massive winners, massive losers. A lot of people come in to any given year and say the same thing. Mike, they'll say it's the year of stock picking, the world of active management. Things have moved on from passive. We're saying it again, Michael, but is this time different?
Look, I think there is, as we're getting further into this cycle, there will be, a lot more nuances there. On Facebook, I do kind of wonder whether that massive miss, Facebook bears have been waiting for that for 3 or 4 years now, right? I mean, there's been, it finally seems to have caught up with it. And I don't know if I don't think it's in any respect some sort of indication of any economic condition. I would make one other point here, which is that, in terms of the broader issue of do you want to allocate to equities in the United States this year or not, it's important to recognize that at least so far, we're a little more than halfway through the earnings season, and certainly a lot of the most prominent names have come, and the revenue beats are more impressive than they were in Q3, and Q3 revenue beats were really quite impressive as well. Earning beats are also quite robust, not quite as robust as the revenue beats. So I think it does sort of, I think, reinforce this notion that we're looking at very robust nominal GDP this year, and obviously, stock picking is important, but I think to think that we're not going to continue to see at the index level very impressive earnings growth this year, even with some margin compression in certain stocks and sectors. I think that's going to be, that's a hard bet to make. I think I'm very constructive on earnings this year and into next year. And I think it's also important to recognize that some of these supply chain issues, as it relates to companies like Ford and so forth, they really do also help reinforce sort of a higher floor of earnings over the next two to 3 years as well.
There's a ton of way of viewing this market. Here's two: Morgan Stanley versus JP Morgan. I think they're just the two worlds right now. Morgan Stanley and Mike Wilson say this: we think the first half of this year could see beat rates fall below zero. This is on earnings. The companies with the greatest earnings risk remain those businesses that benefited from the pandemic pull forward the most. JP Morgan and Mislav Mateka say this: it's wrong to position for a recession given still extremely favorable financing conditions. We look for more gains in earnings, bottoming out in China activity, and expect the Fed not to turn ever more hawkish. Colin Martin, can I come to you on those last two lines there? A bottoming out in China activity and expecting the Fed not to turn ever more hawkish. Just whether those so-called headwinds might develop into being somewhat, at least relatively speaking, tailwinds.
They could be. When you look at China, they've eased a little bit right now. They've made a lot of headlines with the high yield real estate sector and the impacts and the spillover effects there. If there is more easing there, more government support, that could become a tailwind. The Fed, though, that's front and center. If they don't turn more hawkish, that would be a good thing for all risk assets. But going back to a lot of the points that the previous guest made, when we look at the credit markets, I think there will be some more winners and losers going forward as opposed to just winners. And we look back to 2020, the Fed's credit facilities and super easy monetary policies, were the definition of a rising tide lifts all boats. And then we moved into 2021, economic growth was still very, very strong. Monetary policy was still easy and corporate profits continued to grow. It was really, really great for credit fundamentals. But now as we're in 2022, we have the Fed moving to tightening. We have supply chain bottlenecks that are still out there. They seem to be improving, but they're not gone. And that's a risk for junky, high-yield companies who have very thin margins and rely on cash flows. And if there's a delay there, that's a risk. And then inflation, of course. If they can't pass on those price gains to consumers, that eats into their profit margins as well. So we are getting a little bit more cautious there. We see the greatest risk in the triple Cs, the lowest rated of the junk. They just have less wiggle room as the Fed does continue to tighten and as we do see a shift from easy to what will be described as tight financial conditions.
7 minutes into this session, equities advanced just 0.03% on the S&P. Top of the pile, consumer discretionary up 0.7%. At the bottom, energy negative a little more than 1%. We'll return to that energy story in just a moment. Tons of volatility to start the year. Let's get to Katie Lights for more. Hey, Kaylee.
Hey, John. Well, it has been a really wild couple of weeks. I just took a look at the last 14 trading days, so about 3 trading weeks or so. The S&P 500 has moved to the up or downside by at least 1% in 8 of those, so more than half. And for the NASDAQ 100, 10 of the last 14 days have seen a move to the up or downside by 1% or more. And that is just at the closing level, John. That doesn't even go as far as to tell us about the intraday volatility we've experienced with some of the biggest intraday swings going all the way back to 2008. And the thing about it is this volatility isn't limited to penny stocks or lower valuation companies. It has hit the largest companies out there, including mega caps, Amazon and Facebook, which on back-to-back days posted the largest ever one-day market cap loss and one-day market cap gain in U.S. market history. Values literally altered by hundreds of billions of dollars. What's interesting, though, John, is amid all of this, we have actually seen equity volatility begin to retreat. The VIX, which gauges the expected swings on the S&P 500, and the VXN, which is the equivalent gauge for the NASDAQ, did reach their highest level in about a year on January 26th, but things have calmed down since. What hasn't calmed down is the volatility in the bond market, with the MOVE index continuing to move higher and higher, John.
Katie Lights, thank you very much. The volatility, a story to watch, and that story that Victoria Green mentioned, just the divergence, the differentiation between certain sectors within the FANG trade as well. Let's get to Abby for that. Hey, Abby.
Hey, John. Yeah, this is super interesting. There's definitely a tale of 2 stories among the big mega cap tech names this year, and it shows in terms of performance. Now, back in 2020, all of these names, your Amazons, Apples, Facebooks, and so on and so forth, all higher, going the same way. But more recently, it's been Apple and Alphabet to climb higher in yellow and blue. And then, of course, you have Meta Platforms, Netflix, and Amazon going in the wrong direction. So that's a big, big divergence there. Another divergence within the FANG complex that some people may not be aware of, 20% of the NYSE FANG index, it is China tech ADR representation. You can see today Alibaba is down 5.7%, Baidu about flat. But of course, last year, China tech down in a huge way. So that's another piece of the story. But the big story relative to earnings, it's interesting, John, outside of Facebook, all of these companies have beat. Of course, Meta Platforms, they've missed in a big way. But you can see that Tesla and Meta Platforms, after the big earnings reactions, down 12%, then down 26%. Amazon, of course, into its earnings, that surprise to the upside had been down, but then a positive reaction. But big, big reactions, and there does seem to be a massive divergence within the complex, John.
Avi, just unreal. In fact, ridiculous. Can we put that graphic back up on the screen and just leave it there just for a moment, just to take it all in? And Michael Purvis, I want to come to you on some of these numbers. The single-day stock market reaction of an Amazon, of a Facebook, of a Tesla, of an Alphabet, these are monster companies. And never mind the EPS beat and miss, I'd just love to see the market cap gains and losses off the back of this too. Michael, what have you taken away from these wild swings from mega cap stocks?
Well, I don't rush to come up with sort of a fundamental narrative there. Look, I mean, if Amazon's going to be revalued higher or Facebook lower, that's sort of, sort of standard operating procedure off better or poor earnings things. I do think it's an interesting comment just on market structure and sort of the, sort of the growing use of options and the amount of options relative to cash volumes. I think there's a lot of that creates this enormous things. As your colleague was just addressing, like there's been a huge divergence in close-to-close volatility relative at the SPX level relative to intraday volatility in the SPX over the last 3 weeks has been at record highs, multi-year highs, much more so than the close-to-close volatility. And that's really partly a reflection of this earnings price reaction, which I think is also tied to market structure issues, certainly. And let's not forget that a lot of these stocks have been such fantastic winners for so long that people, when Facebook comes in with zero growth in its core business, that's going to get a big reaction.
Information technology doing okay this morning, up 0.4%, about 12 minutes in. The S&P up 0.2%. The underperformance coming from energy. And Victoria, I promised some time with you on that, and I want to do that with you just to wrap up the conversation. Energy's down 0.6%. These stocks have been so hot. Why do you think that this run can continue?
I don't see oil prices going down anytime soon. I think we're in a period of supply and demand crunch, and I think supplies are OPEC Plus can't even meet their 400,000 barrel output because of what's happening in Libya. Maybe Iran comes on, there's tons of things, the what if game, but I honestly think the oil market's a great place to be. Number one, cyclical commodities are a fantastic way to offset inflation. Number two, a lot of these oil companies are massive cash cows. You're not seeing the old wildcatter days where they're plowing all their earnings back in and suddenly the rig count's exploding. No, it's not. The rig count's at 613. We're still well below pandemic highs and much lower than the 2014 highs. So if you look at supply and demand, you see how these companies are reacting. You have a lot of our top picks are actively saying, please, shareholders, take our cash. Devon, EOG, Conoco, you're seeing the buybacks, you're seeing the fixed plus variable dividends. They're actively pushing cash to shareholders as a reward to sticking with them through some tough times. But honestly, I think a bigger risk is energy eventually overheats. Oil over 100 a barrel is not good for the consumer. It hits at the pump too hard, and generally it eventually will drag on the economy some. But right now, if we could sit in the 70 to 90 a barrel range, a lot of the big U.S. oil producers, especially those with a great position in the Permian, their break-evens are in the 30. So they're just printing money for us.
91 right now on WTI Brent at 92.70. Victoria, fantastic as always. Victoria Green, Michael Purvis, Colin Martin. Coming up on the show, inflation concerns looming over the Biden administration just ahead of the midterms.
Look, I'm a capitalist. But capitalism without competition is not capitalism. It's exploitation. So I'm going to continue to do everything in my power to work with the Congress to make our capitalist system work better, to provide more competition and lower prices for American consumers.
That's coming up next. This is Bloomberg.
Job machine is going stronger than ever, fueling a strong recovery and opportunity for hard-working women and men all across this great country. America is back to work.
President Biden taking a victory lap. The White House economic advisor Heather Boushey saying it's up to the Fed to tackle rising cost pressures.
We did what we could on the fiscal side to make sure that we had a swift recovery, that we got jobs back, and then it is up to the Federal Reserve to use their toolbox to ensure price stability.
Out of D.C., Bloomberg's Anne-Marie. Hey, Anne-Marie.
Hey, John, we do see the administration wanting to take a little bit of a turn and repackage how they're going to communicate their economic agenda and policies to the public. So the president there was focusing on jobs after that surprise report on Friday. And we're really going to see the administration talk about wage growth, good paying union jobs, the president always likes to talk about. And thirdly, as well, the domestic manufacturing he wants to put into the economy. We got a glimpse of it on Friday, Jonathan, when he talked about making sure they can get parents back to work, especially women, and that the government could potentially do more when it comes to child care. But Jonathan Keeley, he did not mention Build Back Better, because members of his own party, like Senator Joe Manchin, say that legislation is dead. So it's really going to be a shift in tone to this administration. But what this administration wants to do is address parts of the economy where they think they can expand the productiveness of. Not so much leaning into what Treasury Yellen and her modern supply side theory, but for sure they are trying to find those pockets where they can make a difference in consumers' lives.
AMH, happy birthday down in Washington. Hey, that's the last chance I've got today.
Getting too much
that's the
now.
Last chance
Too
I've got.
much.
That's the last chance I've got. Anne-Marie, thank you.
I'm sure
down
you'll
in
call
DC.
me.
We appreciate it. Looking at crude, 91.15 on WTI. Brent at 92.65. We pull back a little bit. Jeff Curry of Goldman Sachs got my attention. He got your attention this morning. This is what he had to say.
I've been doing this 30 years and I've never seen markets like this. This is a molecule crisis. We're out of everything. I don't care if it's oil, gas, coal, copper, alloy, you name it, we're out of it.
Joining us now, Bloomberg's Julian Lee. Julian, what a line from Jeff Curry.
Yeah, you know, I've been doing this as long as Jeff has, and you really do struggle to see anything like this. The time this most reminds me of is 2007 going into 2008. We know where that ended up. It ended up with crude at just shy of $150 a barrel, followed by the most almighty crash.
Asymmetric risk, Julian, that's what I'm thinking about now. Life above 100 is difficult. Historically, it's tough. And I'm just wondering, when you get to these kind of levels, if you've got a bet on crude or on the underlying commodity producers, is it a bit toppy up here, Julian?
I'm not sure. I mean, I think if you look at the underlying fundamentals, we have relatively strong demand growth still. We're still coming out of the pandemic. There's still a lot of stimulus around. It's perhaps slowly being eased off, but there's a lot of pent-up demand there. And on the supply side, after 2 or 3 years of real underinvestment in new supply, we're seeing the OPEC plus producers beginning to bump up against capacity constraints. We're seeing slower perhaps than expected growth in some of the non-OPEC countries. Eyes are going to be back on the US shale sector without a doubt, and the growth that we see there. But you can see real fundamental tightness here.
Julian Lee of Bloomberg. Julian, great work as always, buddy. The move year to date in the energy names on the S&P, I keep going back to that sector, more than 24% year to date. Just absolutely unreal stuff, with crude at 91 on WTI and Brent at 92.73. Let's get you some sector price action and get across to Kriti Gupta. Hey, Kriti.
Well, good morning, John. You are seeing a little bit of green on the screen, but a lot of it is isolated in big tech. It comes down to that David and Goliath story that you are going to see in markets. Consumer discretionary, information technology, essentially your big tech names leading the way higher. Towards the bottom, you have materials and utilities. Some of that movement in the tech space is also coming from a little bit of that merger Monday. Some questions about who might be a potential candidate to take over Peloton. So you are seeing some of that show up in the price action nevertheless. You are also seeing some of that merger Monday theme in the airlines as well. Frontier Group agreeing to buy Spirit Airlines for $2.9 billion in cash and stock. The deal uniting two ultra-low cost carriers. Now remember, this is coming after months and months of airlines broadly being under pressure. Perhaps this is the moment for them to make a comeback, John.
Is this what Ryanair used to be? Frontier and Spirit? Is that what this is? I've never been on these planes, Kriti. Is that what they are?
Similar story, yeah, essentially.
Like Ryanair back in the day, if you're watching this from Europe, and you all remember what it was like back in the day when you had to run across the tarmac to get a seat because they weren't allocated. Good times. Equities doing okay. Bond yields coming a basis point on twos, just south of 130 on twos right now, 129. A 10-year yield, 192. Yields up a basis point. All I can think about is running across to the plane to go from East Midlands to Bergamo for £15. Coming up, your trading diary from New York City. This is Bloomberg. 25 minutes in, Nasdaq coming back up 0.9%. Let's call it 1% higher on the S&P, up a third. The small caps, the Russell doing okay, up 0.9%. In the bond market, we settled down. This time in and around 130 on twos. Right now coming in a basis point to 129.64. Looking at the Italian bond market, we back away from the session highs too. Guy Johnson and Kelly Lyons will run you through that in just a moment. That's the price action. Here's the trading diary. Looking like this for President Biden, meeting with the German leader, 1:30 Eastern time. Trade balance numbers coming on Tuesday. Wholesale inventories on Wednesday. Plus, Fed Governor Bowman and Cleveland Fed President Loretta Mester speaking later in the day. Then US CPI, the big one for this week, with initial jobless claims on Thursday. Plus, tech earnings continue with Twitter on deck, and rounding out the week with the University of Michigan Consumer Sentiment Survey. From New York City, welcome back to a brand new trading week. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Monday, February 7th. Here are the top market stories we are following for you at this hour. Sovereign sell-off. The global bond rout continues on both sides of the Atlantic as traders brace for more aggressive central bank tightening. We'll hear from the ECB's Christine Lagarde later this hour. Deterrence and diplomacy. Ukraine is front and center as President Biden meets with Germany's Olaf Scholz at the White House today, while France's Emmanuel Macron is in Moscow for talks with Vladimir Putin. And pedal to the metal, Peloton shares surging on reports the company has attracted takeover interest. Its 80% drop from record highs may make the price attractive, but analysts are skeptical about a potential deal. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, it's a new week. Let's hope it's a little less crazy than the previous two.
I'm not sure it started that way, Kaylee. It feels very much like a continuation of what we were talking about Friday. We're going to hear from Christine Lagarde a little bit later on. We've got, as you say, sovereign bond markets firmly in focus. The question of the day is a fairly straightforward one. Who's in charge? Who's driving this narrative? Is it the central banks? Or is it the markets? But I think it needs to be a little bit more nuanced than that. I think it needs to be which markets and then which jurisdictions, because I think if you're looking at Europe, for instance, I think the govie market is more important, certainly when you look at what is happening on the peripheral markets. But credit on both sides of the Atlantic, I think, is absolutely front and center here, and now starting to react. And I think the credit channel is certainly going to be very important for the Fed, less so maybe over here in Europe, where the bank channel certainly dominates. So let's kick this around a little bit. Let's try and figure out exactly what's going to happen and maybe set ourselves up for another interesting week. Christine Aquino joining us, as is Bloomberg's Vince Signorella. Christine, let me start with you and let me pose that question to you. Central banks in charge or markets are in charge? And if we're talking about markets, which markets?
Well, Guy, I think it's very much markets in charge, and specifically the short end of the market is the part of the market that's pricing in all these rate hikes. We've seen this time and time again push central banks into a corner and getting them to respond to it. We definitely got that from the ECB and BOE last week. Definitely more aligned with the markets when it comes to a more hawkish sort of path for policy moving forward. And, you know, that's filtering through to the rest of the markets today, particularly in the periphery where we're seeing Italy and Greece under fire specifically today because of the aftermath of the ECB shift to a more hawkish regime, for instance.
All right, Vince, do you agree with that take? And if so, where else are you seeing it other than the bond market?
Yeah, I totally agree with what Christine is saying, and thankfully it is the markets leading. Central banks, when central banks lead, we tend to see mistakes because their forecasts, unfortunately, are not very good. And we've seen this before with the Fed, where they raised 4 times, only months later to have to cut 4 times because they anticipated too much inflation, and then growth slowed, and they had to come back and ease again. I think this is really positive that the markets are leading. What I would hate to see is March, the Fed raised by 50 basis points to try to take back control of the market. They don't really need to do that. They can follow along nicely. And I think, as you said, where we're seeing it is mostly, as Christine said, the front end of the curve. We're seeing some flattening. I'd expect to see flattening continue. And we're only seeing about 45 basis points in 5s, 30s. I think that can shrink even a little bit more as the shorter end really needs to price in the Fed. The back end that right now doesn't need to be that aggressive.
Vince, the critical channel for the Fed to watch is the credit channel. Thus far, we haven't seen that much impact into the credit channel. We're starting to see it show up now. Is that something the Fed, to your point, is going to have to lean in on? You say you'd hate to see them have to go 50 just to try and regain the narrative. But if the credit market starts to crack, will the Fed be in a position where it needs to take a different course of action?
Well, I mean, hopefully the crack will be a small crack. You know, I mean, there's obviously would be some expectation that the credit markets will suffer a touch as rates go higher and people step back looking for higher yields, more attractive maturities, et cetera, to step in. But I think the credit market's going to hold up just fine. I think there's, you know, even if rates back up a little bit, put a little pressure on credit, there are going to be some very attractive yields in that market to attract investors, especially as we see treasuries, I think, lagging a little bit at this point. You know, we've had a huge move in 10 years up above 1.9%. I don't feel like that has a lot more to go at this point. You know, 2.10 perhaps, but when you start to see, you know, taxable munis start to rates show up very attractive credit, the corporate bond market shows some attractive credit. I think that will bring investors to the market and keep the credit markets in balance.
All right, Christine, on that point of relative attractiveness, how much higher can yields go before they actually start to spell trouble for the equity market and maybe call TINA into question?
Well, Kaylee, that is the big question, isn't it? I mean, we have seen, for instance, earlier this year being thrown around levels around 2% for 10-year Treasury yields as a potential pain point for tech stocks in particular, which we saw did bear the brunt of the earlier sell-off in the equity market. But, you know, we're heading towards levels that could get past that 2% mark. And so I think it is a question of what's the trade-off, you know, in terms of how much further yields could go in above, for instance, earnings yield or other metrics that equity investors tend to look at when trying to make that decision between whether they're going to go for equity still or whether they're going to go for bonds. And so that's going to be definitely one to watch out for, and potentially something that we could see as soon as the next couple of weeks if this sort of price action continues.
Okay, Christine. The other Christine, Christine Lagarde, the president of the ECB, is going to be talking at the top of this hour. She's going to be delivering testimony to the European Parliament, taking Q&A. Does she push back? Does she change the narrative? Does she try and push the markets after today's price action in BTPs and Greek bonds? Does she try and push back this idea that the pivot of the ECB is now underway? Does she talk about spreads? She's on really dangerous ground here. Do you think she goes there?
Well, Guy, I think that's what markets are going to be watching out for sure. I mean, we have seen a tendency from the ECB to, especially in the aftermath of a big rate decision, such as the one that we saw last week, to add some nuance to the messaging in the weeks after that. And so that's definitely what we're going to be watching out for. How much of a pushback is she going to mount against the price action that we're seeing in markets, and whether she will acknowledge the spread? We have seen her time and time again do this to some mixed degrees of success, shall we say. It is quite a tricky communication challenge, especially when bets at the moment are at these levels.
All right, well, we'll wait and see how she handles this in less than 40 minutes time. Thank you so much to Bloomberg's Christine Aquino, as well as Vincent Signorella. Now coming up, we'll continue this conversation, talk about treasuries joining this global bond market route. We'll discuss with Katrina Dudley, an investment strategist and portfolio manager at Franklin Mutual Advisors. This is Bloomberg.
To maintain a pricing
Earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
Let's check in on the Bloomberg First Word News. I'm Rishka Gupta. Russia's Vladimir Putin and France's President Emmanuel Macron are meeting today in Moscow. The Kremlin says the talks will be substantive, but it doesn't expect a breakthrough. Russia has repeatedly denied that it plans to attack Ukraine. The US and the UK say there are now almost 130,000 Russian troops close to the Ukrainian border. A state of emergency has been declared in Canada's capital over a protest against vaccine mandates and COVID restrictions. Hundreds of trucks have been parked in downtown Ottawa near the Canadian Parliament. The city's mayor says that increasingly rowdy demonstrations pose a threat to safety and security of residents. Former New York Governor Andrew Cuomo isn't ruling out another run for the public office, but he says it's too soon to talk about it. Cuomo spoke to Bloomberg 5 months after he resigned over a swell of sexual harassment allegations. He says there were serious mistakes made by New York Attorney General Letitia James and the lawyers who investigated claims against him. James's office says no one can dispute the fact that the investigations found allegations of sexual harassment against Cuomo to be credible. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg. Kaylee.
Ritika, thank you. Let's get back to the markets now, because that worldwide rout in the bond market is expanding today, and now treasuries are among the bonds that are falling. That brings us to our question of the day. We basically want to know, who is in charge here? Is it central banks that are leading, or are they just following the markets that are actually in the lead? Joining us now to hopefully help us answer that question is Katrina Dudley, Franklin Mutual Advisors investment strategist and portfolio manager. Katrina, is this a market that is front-running what central banks are doing, and central banks are basically just adapting to it? What do you think?
Look, there's a feedback mechanism that exists between the markets and the bond markets, equity and bonds. And I think what you've got is a couple of things going on. First of all, Christine Lagarde is responding to the fact that she's got to be very careful in her hawkish comments, because they don't want to have another tantrum like we did about a year ago, when your comments about rising yields in Europe caused the Italian markets to blow out. And you have a nascent kind of government there and a recovery. So I think that they're focusing on that transmission mechanism, as opposed to looking at how bond markets and equity markets are linked. The second thing, though, I think is going to be very interesting is that the typical link that we see between Treasury and bond yields and inflation, we're a little concerned that that may not actually come into play this time, given the fact that you've got a federal government that really wants to spend money. And normally you get deflation or a tightening of inflation conditions when the federal government tightens. And at this time, the U.S. is really trying to spend its way out of this. So we may not necessarily have the transmission mechanisms that the Fed is hoping for.
Can you just sort of expand on that a little bit? What are the implications for the various asset classes if that's the case?
Well, the first thing is that we're looking at inflation in the U.S., and we have been very, very surprised at how high it is. And it's now not just high as noticed by equity markets, it's high inflation as noticed by people on the streets. How does that impact equity markets? It makes products more expensive. Normally, when you have expectations of products being more expensive, people tend to buy today instead of deferring consumption. But at this stage, because people really don't have a lot of pent-up demand, particularly for home goods and capital goods, I think that we're not necessarily going to see that acceleration. So we're a little cautious in some of the areas of the market where you need demand to continue to be strong, and inflation could actually retard that.
Where does that put U.S. equities relative to, say, European ones, Katrina?
I've been a European fund manager for my entire career. I now do global as well. And I think I've always had a positive bias on Europe. And I think this time I'm actually really confident in that positive bias. First of all, let's take a look at valuations. The European market is cheaper. We can go into specific sectors where there's even better opportunities in the European market than, say, the US market. Secondly, you have that recovery fund that was passed well over a year ago, and it's finally going to come into GDP. And then on the inflation front, the real drivers of inflation that exist in the United States are just not present in Europe. So you don't have such the wage pressure that you have in the United States. You don't have the same pressure from the owner-occupied housing, which isn't actually in European inflation markets. And the bump in energy prices, which is in inflation, is really a transitory impact. So I think the setup for Europe this year is really good.
Katrina, the outperformers thus far this year certainly include the banks. I've got the names on the screen right now. Sabadell, 43% to the upside. CaixaBank, 33%. Bank of Ireland, 30%. Commerzbank's up 28%. These are big moves that have already been made already. And I'm also wondering whether some of the peripheral banks in particular are going to be able to manage higher yields. The Italian banks in particular own an awful lot of BTPs, I think circa 800 billion. If we do see yields gapping higher, do you really want to own those institutions?
You talk about the bounces off the bottom, but I think some of those bottoms were artificially low. So you've really kind of got to look at where the stocks are on an average basis. So I think that that upside isn't quite so great. The second thing is the setup for European banks is really positive this year. They're actually going to be in the market now paying dividends and potentially buying back shares. That's very different to what they've been in the past. They've also upgraded the quality of the balance sheet. So while you talk about the Italians, which have, some issues with their balance sheet, a lot of the other banks have really high quality balance sheets. Finally, if you look at valuations, the stocks trade at 9-10 times earnings, which is a significant discount to their U.S. peers. U.S. peers are reflecting the returns in their multiples of earnings that they're trading at. The Europeans are not. And you're getting these assets at discounts to book value. And with returns that are going to be greater than the cost of capital, I think the setup, despite the moves off the bottom, is really positive.
On the subject of valuations, Katrina, how high a multiple are you willing to pay to own a stock in this environment?
I'm a value investor, so I like cheap multiples. We don't tend to, to buy companies that are trading at 100 times earnings, 100 or 10 times revenues. I think in terms of looking at that multiple, the bond yields do come into play here, and that is the pressure that you're seeing on growth stocks. The question is, you really need to take that long-term look and have a look at what the cash flow of these businesses are going to be, because that takes out the multiple equation. Multiples are very, very sensitive. Cash flow is something you can elongate and look at, and you can test those sensitivities. Finally, a lot of these tech companies are not levered, so they're not going to see a higher cost in terms of higher interest rates from the rising rates. They're just seeing it, as I said, in terms of the discounting of those future cash flows.
Katrina, do I need to include some geopolitical risk into my European positions when I think about them? We don't know what's going to happen in Ukraine, but if things take a turn for a worse, we could see significant energy price escalation even from here. We've already seen one bout of this. We could get another. European industrials are very exposed to this.
Yes, they are exposed to it. I think that you've got a lot of geopolitical tension, and trying to predict what Putin is going to do is it's just a quandary that we don't really know what's going to happen. The fact is, however, is a lot of these European companies don't just sell their products into Europe. They sell their products into the United States. They're also very exposed to China, which has just stimulated its economy. So even though you have some of these headwinds, I think that they've got some very good growth prospects. The second thing, if they do see rising energy costs, you just want to be in those industrials that can pass it on through pricing power, because it's the same way when we look at the U.S. industrials. We're looking for companies that have got strong market position, monopolies, which basically give them that pricing power, because that is the ability to cope with any type of inflation in costs, be it energy, wages, or the like.
Katrina, we just had a viewer writing in on IB on the Bloomberg terminal asking about those European banks. What kind of risk premium do you incorporate on the corporate governance side, given that there's always a constant barrage of headlines about turmoil in the C-suites and at the high levels of some of these banks?
Yes, you've seen it at Credit Suisse. Obviously, you've seen it at Deutsche Bank and everything. The fact is, you can look at it negatively, the way that you're talking about needing to incorporate a higher risk premium, or you could take a positive stance, is that they are now realizing that governance is very important to the investor base, not just in the US, but also in Europe. And this is a real call to action. I think in the Credit Suisse case, you could potentially say that they've taken the COVID violations seriously and they've implemented, their policy. Probably in the past, you may have had some of these type of things swept under the carpet, but now the banks are acting positively. So I think if I look at it versus even 10 years ago, that risk premium should be lower because they're a lot more proactive, particularly on the governance front.
Really useful insight, Katrina. Thank you so much for joining us today. We greatly appreciate it. Katrina Dudley of Franklin Mutual Advisors. Thank you. Right, what are we going to be doing next? Shares in Peloton up sharply today. The fitness company is said to be exploring takeover options. A couple of big names being mentioned as potential acquirers. Nike's one of them. I'm hearing Apple being talked about. Amazon maybe in the mix as well. We'll talk about all of this next. This is Bloomberg.
About that all day yesterday.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. Frontier Airlines has agreed to buy Spirit in a takeover that combines two of the U.S.'s bargain carriers. The price, $2.9 billion in cash and stock. The private equity firm Indigo Partners owns a majority stake in Frontier and is the largest shareholder in Hungary's Wizz Air. Shares of Peloton are soaring today. The company is said to be exploring takeover options. There are also reports that Amazon and Nike are both considering making offers. Before today, Peloton stock had fallen more than 80% from the high a year ago. And that's your Business Flash Guy.
Okay, Kaylee, let's pick up and talk about that last story. It's probably worth focusing a little bit more on it given the share price move that we're seeing. Amin Ben-Said, who covers the company for Bloomberg Intelligence, joins us now to give us a take. I mean, the share price is down so much, at some point we were definitely going to be talking about potential takeovers. I've got the Journal talking about Amazon. I think I've got the FT talking about Nike. I think Wedbush is talking about Apple. How credible is this idea that we could see a takeover here?
Thanks very much. So it's a very good question because when we look at Peloton share structure, first of all, if Peloton doesn't want to be sold, it's not going to happen because when you look at their share ownership, Class B shares have around 66% ownership for the whole for the voting rights, basically. But to your point, it looks like maybe fitness apparels or companies who want to have that premium fitness experience could be better fit. It's still hard to say at this point of time if tech players could be a good fit, but we will have to see how that how that extends.
Okay, but on the subject of those tech players, I mean, we know that they are subject to a certain degree of regulatory scrutiny as well. How much could that be an issue here if someone were to pursue an acquisition?
It's still early to say, but since Peloton's market cap has relatively, as you guys mentioned earlier, significantly declined since the height of the pandemics. In addition to that, a lot of the tech players, their fitness platforms are still relatively small, and even acquiring Peloton, it doesn't look like it will put them to a level where it could raise some regulatory issues there. But again, it's still early to say. So far, it doesn't look like it may be a significant challenge.
I mean, let's just talk about kind of where Peloton is in its journey. Clearly, it was a lockdown darling, and the stock price maybe got ahead of itself. We're now getting a kind of opposite and equal reaction to that. Actually, the shares are down very hard. But how big could this space be? What is the opportunity if this business stays as a standalone?
Yeah, so the U.S. fitness revenue is around 30 billion. Has been growing relatively stable, of course, pre-pandemic. Looking at Peloton more specifically, that is, the focus, or that is where the TAM could be. The issue that they have is, of course, as you mentioned, they benefited from the pandemic. They had significant pull forward, but now they have more supply than demand, unfortunately. So cardio platforms, they're doing relatively well, especially, with treadmills and bikes. But when you go outside of that, there is not that many other fitness verticals or other products that they have. So maybe strength or things of that sort could help them, boost their growth numbers.
All right, thank you so much for your input on this. Amin Bensaid of Bloomberg Intelligence, appreciate your time. Peloton shares up 22% with it about an hour into the U.S. trading session. Now, coming up, we'll get back to geopolitics because the new Chancellor of Germany, Olaf Scholz, has started a round of diplomacy in the midst of crisis talks over Ukraine. His first stop is the White House, and we'll talk with the former U.S. ambassador to Germany, John Emerson, next. This is Bloomberg.
us.
We're an hour into the U.S. trading session, and Bloomberg's Abigail Doolittle is tracking the move. So, Abigail, it's a new week. I don't want to speak too soon, but it looks a little calmer out there than it did last week.
It does look a little calmer, but I wanted to set the stage and show what we're coming out of, because, of course, this year has been all about volatility, big moves up and down on the days and on an intraday basis. Net at this point, you have the S&P 500 basically down about 5%, down in a big way, up that intraday volatility. But to Kaylee's point today, the moves are much smaller. The Dow, the last time I looked, was slightly lower, the S&P 500 slightly higher. As for the NASDAQ 100 and some of those tech indexes, the last time I looked, we saw gains, yes, for the NASDAQ 100 up about 0.4%. The stocks, the chip index, up a little bit more, but there are some divergences because you can see the NYSE Plus FANG index, it is down about 0.6%. That has everything to do with its roughly 20% weighting to China tech ADRs. Alibaba in particular is down sharply. This divergence is true too for U.S. mega caps. Alphabet and Amazon, both actually Amazon and Tesla higher. Tesla off of its highs. Earlier it had been up about more than 1%, but you can see Amazon still in that strong quarter glow, up 2.5%. To the downside, though, we still have Meta Platforms down after the not so great quarter follow through, and Netflix down 2.1%. So we have this divergence of haves and have-nots within mega cap, but the big macro influence, of course, that has to do with rates, Guy. If we take a look at the 10-year yield, recently at its highest level since late 2019, early 2020. Overall, it's a choppy uptrend, but it is an uptrend. Higher, higher, higher. It looks like 2% is not so far away. If that should happen, and again, it looks like it will, how will big tech digest that big round number? Perhaps we'll find out sooner rather than later, Guy.
Absolutely. The rate of change really impressive right now. Bonds certainly the story over here in Europe. Remember, we're counting you down to Christine Lagarde, the president of the ECB, talking in front of the European Parliament at the top of the hour. Let's stay with the European focus. Germany's new Chancellor, Olaf Scholz, very much under pressure. The idea is he needs to take a position on Russia and its military buildup on the border of Ukraine. He gets a chance today maybe to do that. He is going to be meeting President Biden at the White House. Joining us now, Bloomberg's Joe Matthew from D.C. Joe, what is the White House hoping for, expecting from this meeting with the German Chancellor?
It's all about unity today, Guy, presenting a unified front. The White House has scheduled just under 2 hours for the two leaders to meet in the Oval Office. That will be followed by a news conference, a joint news conference in the East Room. A lot of questions to be asked here, Guy. We're going to be looking for answers, and Bloomberg will be in the room, specifically to Nord Stream 2 and how Scholz comes down on this with regard to any potential sanctions that could be imposed. Look, you know as well that there have been a lot of questions about Germany's resolve when it comes to protecting Ukraine in dealing with Russia. Scholz sat for an interview with the Washington Post ahead of this visit today, pledging a united and decisive response to any invasion by Russia. Happening at the same time as French President Emmanuel Macron meets today in Moscow with Vladimir Putin. As these conversations continue, Guy, a series of talks underway at diffusing tensions and avoiding an invasion that we should note Russia to this day claims it is not planning. Guy?
Joe, is the U.S. and France on the same page? Obviously, there's some issues in particular with Germany in regard to energy flows, but we know President Biden spoke with Macron yesterday on the phone before that meeting in Moscow. How much are they aligned?
They seem to be, for the most part, but we have to remember that these talks are happening against the backdrop of the U.S. trying to locate more gas, liquefied natural gas from our allies that could be sent as an alternative, if you will, to Europe in the midst of this winter if Russia decided to shut this off. But this is, you know, an interesting decentralization of talks. The U.S. has decided to let Macron go ahead with his own tact, with Scholz and his own tact, the EU and NATO with their own. So not all of the burden is on this White House.
All right, thank you so much to Bloomberg's Joe Matthew in D.C. covering what is happening at the White House today for us. And we also want to pay attention to what is happening in Moscow, which Joe mentioned. French President Emmanuel Macron is meeting with Vladimir Putin. We actually have some images of that meeting has just begun, and we are expecting these two to hold a joint news conference later on today. Again, Vladimir Putin and Emmanuel Macron meeting in Moscow. But we want to focus more on the particular conversation when it comes to the U.S. and Germany. And joining us now is John Emerson, chairman of the American Council on Germany and a former U.S. ambassador to Germany.